we bring market dynamics together with up-to-date analytics. Welcome to Quants Pro. Let's see what topics are in this content. As the UK grapples with structural, political, and economic issues, how are markets affected across assets, and what stories may look better for investors than others? Chief cross-asset strategist Andrew Sheets and UK economist Bruna Skarika discuss. In our content we have prepared for you, our guests will give information about the volatility that dominates the markets. There are also important findings about quantitative tightening in the content. Sit back and listen with great pleasure to our guests' amazing findings while sipping your coffee. In the meantime, do not forget to like and subscribe to the video so that we can prepare more rich and quality content for you.
Welcome to Thoughts in the Market. I'm Andrew Sheets, Morgan Stanley's Chief Cross-Asset Strategist.
And I'm Bruna Skarika, Morgan Stanley's UK economist.
We'll be talking about the market implications of the latest political, economic, and market developments in the UK. It's Friday, October 28th at 2 p.m. in London.
So Andrew, we already discussed the economic outlook for the UK, and today I'd like to turn our conversation to you and your cross-asset views. Obviously, the current economic and political situation in the UK has a very significant impact on both macro and micro markets. Let's start with one of the number one investor questions around the UK, which is the mortgage market. Roughly 1 in 4 mortgages has a variable rate, and current estimates suggest that more than a third of UK mortgage holders will see their rates rise from under 2 to over 6% over the next year. What is your outlook for the mortgage market and its impact on the UK consumer, especially amid what is already severe cost of living crisis?
Like the US, most household debt in the UK is held in the form of mortgages. Unlike the US, though, those mortgages tend to have a quite short period where the rate is fixed. The typical UK mortgage, the rate is only fixed for 2 to 5 years, which means that if you bought a house in 2020 or 2021, a lot of those mortgages are coming due for a reset very soon, and that reset is large. The mortgage, when it was taken out in 2020, might have had a rate of 2%. The current rate that it will reset to is closer to 6%. So that's a tripling of the interest rate that these homeowners face. So this is a very severe consumer shock, especially if you layer it on top of higher utility bills. This is, I think, a big challenge that, as you correctly identified in our conversation yesterday, that the Bank of England is worried about. And, this is one reason why we think the pound will weaken. I'm sure we'll talk about the pound more, but if rate rises in the UK work their way into the household much faster because the mortgage fixed period is much shorter, maybe that means the Bank of England can't hike as much as markets expect, whereas the Fed can, because the dynamics in the mortgage market are so much different.
Indeed. Now, aside from that, UK rates have also seen a historical level of volatility this year. The pound as well has been weak all year, even though it has rallied a bit recently. Perhaps let's focus on the currency first. How do you see the pound from here? Do you think the downside risks have subsided, or the structural risks still remain?
So the pound is a very inexpensive currency. It's inexpensive on a number of the different valuation measures that we look at: purchasing power parity, real effective exchange rate, and it's certainly fallen a lot. But our view is that the pound will fall further, and that this temporary bounce that the pound has enjoyed in the aftermath of another new leadership team in the country is ultimately going to be short-lived. A lot of the economic challenges that were there before the mini budget are still there: weak economic growth, large current account deficit, trade friction coming out of Brexit. And also, I think this part about the Bank of England maybe not raising rates as much as the market expects, there's that much less interest income for investors for holding the pound. We forecast a medium-term level for the pound relative to the dollar, about 1.05, so still lower from here. And we do think the pound will be the underperformer across UK assets.
Now, aside from the pound, I've mentioned investors have been very focused on the UK rates market, where we have indeed seen a lot of volatility in recent weeks. Now, what do valuations look like here after all the fiscal U-turns? And is Morgan Stanley still bearish on gilts?
It's common to talk about historic moves in the global market, and sometimes you realize you're talking about a market that's been around for 10 years or 20 years. The UK bond market's been around for hundreds of years. And we saw some of the largest moves in that history over the last 2 months. So these have been really extreme moves, both up and down, as a result of the fallout from that mini budget. But going forward, we think UK rates will rise further from here. We think bonds will underperform, and there are a couple of reasons for that. One is that the real interest rate on UK gilts, the yield above expected inflation, it's not very high. It's about zero, actually. Whereas if I invest in a US inflation protected security, I get about 1.5% more than the inflation rate. And then I think you add on this challenge of it's a smaller market, you add on the challenge of there's more political uncertainty, and then you add in the risk that inflation stays higher than the Bank of England expects, that core inflation remains more persistent. And I think all of these are reasons why the market could inject a little bit more risk premium into the gilt market. One other thing that's been highlighted by our colleagues in interest rate strategy is just simply there's a lot of supply of gilts. There's supply of gilts, not just because the government's running a deficit, but there's supply because the Bank of England was a major buyer and a major holder of gilts during the era of quantitative easing, and it's shifting towards quantitative tightening. So heavy supply, low real rates, and I think potential for kind of a higher risk premium are all reasons why we think gilts underperform both bonds and treasuries.
Now that you mentioned quantitative tightening, of course, the Bank of England is planning to sell its credit holdings as well. What is the situation in the sterling credit market? Can you walk us through the challenges and opportunities there right now for both domestic and foreign investors?
Yeah, so I think the credit market in the UK is actually one of the better stories in this market. Now, it's not particularly liquid, but I think where sterling credit has some advantages is, one, it's actually a relatively international market. Only about half of it references UK companies. The other half of it is global companies, including a lot of US issuers. So the credit market is not a particularly domestically focused index to the extent people are worried about the UK domestic situation. It's a market that trades at a spread discount to the US, both because of some of the recent volatility and the fact that it's a little bit less liquid. This is a market that yields around 6.5%, 6.75% on investment grade credit. That's, I think, a pretty good return relative to expected inflation, relative to where we think credit risk is in that market. So, amidst some other more difficult stories, we think the credit market might end up being a relatively better one.
Finally, let's take a step back, perhaps, and take a look at some of the UK's structural vulnerabilities. The UK has a very weak net international investment position. It's reliant on foreign money to fund some of its deficit. And despite the recent fiscal U-turns, the UK's fiscal deficit is still relatively large. In the context of these vulnerabilities, can you maybe discuss how recent events have affected foreign investors' confidence, and how do you see things going forward?
Yeah, so I think this is a really important issue and maybe a good one to close on. The UK, as you just mentioned, runs a very large current account deficit. It imports much more than it exports. And when you do that, you need to attract foreign capital to make up that difference. Now, the US also imports more than it exports. The US also runs a large current account deficit. But because the US is this large, deep capital market, it's seen as a relative winner in the global economy in terms of the makeup of its companies and its longer term growth, it tends to have an easier time attracting that foreign capital. The UK has more challenges there. It's a much smaller market. It doesn't have the same sort of tech leadership that you see in the US. And in terms of attracting the foreign capital into the equity market, well, that's been more difficult because you've had some uncertainty over what UK corporate tax policy will be. The UK equity market also tends to be quite energy and commodity focused. So in an ESG focused world, it's more complicated to attract inward investment. And then on the bond market side, the UK's bonds don't yield more than UK inflation at the moment. So again, that's probably worked against attracting foreign investment. So maybe one other factor there that is important, and we've touched this in a glancing way throughout this conversation, is Brexit, that the UK's exit from the European Union does still present a number of big uncertainties around how UK companies and the UK economy will operate relative to its largest trading partner. And so again, we can see a scenario where just simply higher risk premiums or lower valuations are ultimately needed to clear the market. So Bruna, thanks for taking the time to talk.
Thanks, Andrew.
We are constantly working to gain your trust with richer content. Please don't forget to like and subscribe. Now Quants Pro. We present the bonus stock analysis that the team has meticulously prepared for you. For stock reports specific to our followers, please do not forget to write the name of the stock you want to analyze and your email address in the comments section. Welcome to the Market Insights session specially prepared for companies. I'm Lisa and my friend David. Hi, David.
Hi, Lisa.
Our content, which we have prepared for investors who value innovative analytics while managing their portfolio, includes powerful decision support hardware. We start our content that we have prepared by using current academic techniques. When we examine the chart of the stock carefully, we can see that there has been a downward trend in the last weeks. Decreases in trading volume accompany this trend.
It is worth emphasizing this point. Sometimes, serious upward or downward movements in the trading volume may indicate a feature that supports the trend of the stock. In addition, the investor should benefit from other technical analysis findings while taking a position.
You're so right, David. Even if the trading volume alone does not produce a solid signal, it can be useful when used in conjunction with accurate technical analysis methods. Let's examine our other parameter. We see that the moving average convergence-divergence curve integrated into the chart goes out of the threshold range. The share price can be said to be extremely low as the moving average crosses the lower threshold. Finally, let's examine the commodity channel index oscillator embedded in the graph at the bottom. This indicator gives information about the deviation levels from the price trend. When the chart is carefully examined, it can be seen that the price action is within the oscillator band. In this case, it can be said that there is no excessive movement in the share price. When the Bollinger Band accompanying the share price is examined, it can be seen that the price remains within the band. This indicates that the share price moves close to its dynamic average. It is still early to take a position in terms of buy or sell decisions. None of the technical analysis indicators expressed in the chart alone can create a buy or sell decision. It is beneficial for the investor to prefer alternative technical analysis methods when making a buy or sell decision.
For me, the Bollinger Band is a very simple and understandable instrument. Perhaps that is why it is widely used.
Now let's examine the performance of the company's competitors. When the graph is carefully examined, the price performances of the rival companies as of the previous day's closing can be seen. Why are the rival performances important, David? What do you think about this topic?
I think it's an important indicator for investors. Because if the company competing with its competitors in the same industry conditions is in a better position than its competitors, this may be due to the internal dynamics of the company. Even this probability is quite high. This can be understood as a positive signal.
Of course, the reverse is also true, right?
Definitely, Lisa.
Let's continue. In the graph on the screen, the red indicator shows the company's percentage performance, and the yellow indicator shows the competitor's percentage price performance. Of course, the red indicator passing the yellow indicator to the right is an important development in terms of company performance. Quants Pro followers, some descriptive information about the stock is as on the screen as of the specified date. Let's take a look at the descriptive parameters of stock which you are considering trading in order to take a good position in the markets and evaluate the opportunities. By the way, most of the parameters are dynamics that make sense in the long run. Most of the descriptive parameters were obtained with a deterministic approach. Let's examine the performance of the stock in terms of some parameters. Considering the content carefully, the price-earnings ratio is an important indicator for investors. This ratio is used to calculate the relative value of the stock. This ratio also helps determine whether the stock is overvalued or undervalued. In this sense, analysts use the price-earnings ratio when they want to determine whether the share price accurately represents projected earnings per share. Of course, this ratio is not an indicator to be used alone. It can be used more efficiently, especially for intercompany or periodical comparisons. Instead of sticking to one parameter, it would be a better behavior to make a buy and sell decision by including different technical analysis parameters in the analysis. The price ranges in the daily and 52-week range are given in the table. Investors' perception of short or long-term changes his sensitivity to price movements. In this sense, it is important how long the investor will keep the stock in his portfolio, as well as at what price he will buy the share. Sometimes the oscillations in the markets are so severe that relevant prices can be tested sooner than expected. While the daily price range is an important indicator of the buy or sell level of the stock price, the weekly price range provides a more robust analysis capability. The market capitalization value, which expresses the weight of the company's performance in the market, is as in the table. Market cap provides information about the market size of the stock. It is obtained by multiplying the total number of shares of the company by the current market price of the shares. Of course, although this classification is important for a stock career, it does not provide a sharp assessment for buy or sell decisions. Large cap, $10 billion or more, mid cap, $2 billion to $10 billion, small cap, $300 million to $2 billion. Shares outstanding refer to a company's stock currently held by all its shareholders, including share blocks held by institutional investors and restricted shares owned by the company's officers and insiders. Outstanding shares are shown on a company's balance sheet under the heading Capital Stock. Since the data in the balance sheet and other financial statements of the companies provide vital information about the genetics of the company, they are the most organic findings that affect the investment decisions. Public float value is as in the table. Public float may refer to all the shares outstanding that can be publicly traded. The company's beta value is as in the table. A beta value greater than 1 indicates that the stock of the company oscillates more than the market average. This indicates high volatility. On the contrary, if it is less than 1, it indicates that it has a volatility below the market average. From this point of view, beta value greater than 1 creates a suitable investment ground for risk-loving investors. However, for the cautious investor, the low beta value may be more preferable. In particular, it is important for the investor who will hedge their positions against high volatility to consider the periodic comparison of the beta value. Beta value is more useful when evaluated together with other factors that characterize the market. Beta value can give important clues to investors in terms of measuring price risk. The revenue per employee value represents the income per employee. The revenue per employee ratio is most useful when looking at historical changes in a company's own ratio, or when comparing it against that of other companies in the same industry as part of a fundamental analysis. The EPS value, which is an important index, is as in the table. Earnings per share represents earnings per share. The higher a company's EPS, the more profitable it is considered to be. EPS value by itself is meaningless. Periodic mobility in comparison with other companies can be examined. Yield is a return measure for an investment over a set period of time, expressed as a percentage. Yield value alone does not make sense for the investment decision. Dividend value is the dividend payment to shareholders in stock rather than money. Dividend refers to a reward, cash or otherwise, that a company gives to its shareholders. Dividends can be issued in a variety of ways, whether in cash, stock, or any other form. Short interest indicates how many shares of a company are currently sold short and not yet covered. Short interest is used as a sentiment indicator. An increase in short interest often signals that investors have become more bearish, while a decrease in short interest signals they have become more bullish. A large increase or decrease in a stock's short interest from the previous month could be particularly indicative of sentiment. For example, when the short interest for a stock rises from 5% to 10%, it may be a warning sign that sentiment is growing negative on a company. Large changes in the short interest also flash warning signs, as it shows investors may be turning more bearish or bullish on a stock. For investors considering long-term trading, increases in short interest rates may be a sign of concern about the stock. Short interest is most useful when looking at historical changes in a company's own ratio, or when comparing it against that of other companies in the same industry as part of a fundamental analysis. Float shorted is the percentage of a company's stock that has been shorted by institutional traders, compared to the number of shares of a company's stock that are available to the public. Average trading volume and previous closing price are as in the table. Average volume is the average number of shares traded within a day in a given stock. It is especially useful to evaluate it together with other indicators. Because the serious increases and decreases in the average trading volume make sense of other indicator signals. When average volume increases or decreases dramatically, it signals that there has been a substantial shift in how people value or view the asset. Usually, higher average daily trading volume means that the security is more competitive, has narrower spreads, and is typically less volatile. Stocks tend to be less volatile when they have higher average daily trading volumes, because much larger trades would have to be made to affect the price. This does not mean a stock with high volume won't have large daily price moves. On any single day, or over multiple days, any stock can have a very large price move on higher than average volume. Average daily trading volume is a useful tool for analyzing the price action of any liquid asset. If the price of an asset is range-bound and a breakout occurs, increasing volume tends to confirm that breakout. A lack of volume indicates the breakout may fail. Volume also helps confirm price moves either higher or lower. During strong price pushes up or down, volume should also rise. If it isn't, there may not be enough interest to keep pushing the price. If there isn't enough interest, then the price may pull back. Yes. Quants Pro followers. Now, if we turn to technical analysis, we will be happy to present to you the Quants Pro Advanced Fibonacci Retracement Method, a brand new scale created by Quants Pro for you. Let's first examine the classical Fibonacci retracement. You can see the possible support and resistance points on the chart. The usual Fibonacci scale is a classic and widely used indicator. However, it should be noted that one of the important reasons why the vast majority of investors fail may be the use of the usual Fibonacci scale. In this case, investors may lose because they have taken positions on the wrong Fibonacci levels. Quants Pro Advanced Fibonacci Retracement Scale has been specially designed by our experts working for you. This scale is based on Quants Pro Advanced Fibonacci Base Level. Quants Pro reserves the calculation of base level. You see the QP Advanced Fibonacci retracement levels on the chart. These levels provide more accurate support and resistance values. In this way, stop loss and take profit levels can be redesigned more accurately. In order to minimize the risk, it is beneficial to consider the Quants Pro Advanced Fibonacci Retracement Scale together with other technical analysis methods.
Lisa,
Yes, David.
with your permission, I would like to thank our team for bringing this wonderful tool to the financial literature. It's truly an excellent scale that will cause traders to reconsider classic support and resistance points.
After analytics with key characteristics for the investment vehicle, it would be helpful to provide information about returns. The general course of returns is extremely important for the investor in the final scenario. As a result, we all dream of an investment instrument with a high cumulative return at the end of the period. Cumulative returns do not give absolute information about the buy or sell signal or the timing of these, but it can give an idea about the contribution of the investment instruments to the investment portfolio and its periodic performance. When the chart is carefully examined, it can be seen that the cumulative returns have been increasing recently. This situation can be considered as a positive signal about the investment vehicle.
Now we present to you a brand new experience of Quants Pro News Impact Analytics. The news effect, which is theoretically based on the effect of negative or positive errors on the variance of the investment instrument, in practice refers to the effect of good or bad news on volatility. For this purpose, Quants Pro meticulously examined the comments of the stock and created the news effect graph for you. You can see the news effect for the stock in the chart. When the graph is carefully examined, it is seen that negative news affects volatility more. In this case, the investor should know that negative events regarding the stock will be more destructive. Investors should make use of other technical analysis instruments when making their decisions. Dear Quants Pro followers, we present to you by examining some technical analysis parameters in depth in order to gain more qualified equipment for decision making. For this purpose, our first indicator that we will present to you is EPS performance. Numerical changes in the EPS trend are an important indicator for investors. Earnings per share is one of the most important metrics employed when determining a firm's profitability on an absolute basis. It is also a major component of calculating the price-to-earnings (PE) ratio, where the E in PE refers to EPS. By dividing a company's share price by its earnings per share, an investor can see the value of a stock in terms of how much the market is willing to pay for each dollar of earnings. Comparing EPS in absolute terms may not have much meaning to investors because ordinary shareholders do not have direct access to the earnings. Instead, investors will compare EPS with the share price of the stock to determine the value of earnings and how investors feel about future growth. Periodic forecasts about the EPS trend can be viewed from the chart.
It should also be emphasized that estimates in EPS rates may become more consistent as we move from their 90-day values to their 1-week values. In this sense, periodic differences can give clues about the quality of volatility in the price of the stock. The numerical distance between forecasts for periods of high volatility increases. The reverse is also true. What counts as a good EPS will depend on factors such as the recent performance of the company, the performance of its competitors, and the expectations of the analysts who follow the stock. Sometimes, a company might report growing EPS, but the stock might decline in price if analysts were expecting an even higher number. Likewise, a shrinking EPS figure might nonetheless lead to a price increase if analysts were expecting an even worse result. It is important to always judge EPS in relation to the company's share price, such as by looking at the company's PE or earnings yield.
Thank you, David. You can examine the graph on the screen to learn about the variability of the periodic forecasts made by our team. In the graph where the EPS trend is examined, we can say that the thin candles belong to more consistent forecasts. In the graph here, the significance of the estimations for the EPS trend, in terms of the relevant time periods, are given in parentheses. Periodic significance can be viewed from the table on the screen.
I think the comparison expressed in the first line is more important for the investor who follows the near term.
Of course, David. Periods comparison of forecasts for EPS trend between periods is directly related to investors' time management. Shorter-term investors wonder about the differences in forecasts between consecutive periods in the near term. Comments on the significant differences between the periods can be examined in the table. If we give a score to the stock as a result of the analytics done so far, our review of Quants Pro Advanced Fibonacci Analytics, News Impact Analytics, and analytics comparing the company to competitors would be prudent. In this case, the company's Quants Pro score is on the screen. We offer you up-to-date analytics about the investment vehicle you are wondering about. We hope that you will write your criticisms and suggestions in the comments section of the video. I'm Lisa and my friend David came to life with your support. So don't forget to like the video and subscribe. See you in the next content.
Quants Pro. Market Insights generates useful analytics. Would you like to contribute to our ability to produce richer content? Then don't forget to subscribe to our channel and like it.